Heading into the July jobs report, the economic consensus was stable. Forecasters broadly expected the U.S. economy to comfortably add about 80,000 new positions to the payrolls, keeping the engine humming at a manageable pace. But the expected 80,000 gain entirely collapsed, plunging to a net loss of 23,000 jobs. The Labor Department also revised May and June downward by 103,000 jobs, wiping the perceived hiring momentum of the early summer right off the ledger. Beyond the hiring freeze, 264,000 Americans stopped looking for jobs entirely in July. This mass exit dragged the overall labor participation rate down to 61.4%, a 5.5-year low. In financial markets, a sudden multi-month deterioration in employment creates an immediate vacuum of confidence. When growth stalls this sharply, massive amounts of institutional capital immediately scramble for safe haven assets. To understand why Wall Street reacted so aggressively, you must break down where the damage occurred. The losses hit heavily across local government education, the retail trade, and financial activities. Hiring in manufacturing completely stalled, and construction showed zero movement. Even the reliable bright spots showed signs of fatigue. Healthcare did manage to add 22,000 jobs, but that pace drastically underperformed the sector's own annual average over the previous year. Because this weakness infected nearly every major pillar of the U.S. labor market simultaneously, traders instantly realized the Federal Reserve's current economic playbook would have to be scrapped. There is a core macroeconomic rule that dictates bond markets. A shrinking labor market drastically reduces the likelihood that the Federal Reserve will raise interest rates to cool down the economy. Before the data hit, the market priced a September rate hike at 56%. When the jobs report landed, that probability dialed back to 43.9%. This sudden drop triggered an immediate sell-off, with the 2-year Treasury yield plunging, dragging the 10-year yield down. The ripple effect instantly hit global currency markets. Because yields dictate demand for the dollar, the U.S. dollar index sank toward 99.49, losing significant ground against both the yen and the euro. This creates a compounding mathematical effect. A weakening dollar, combined with falling government bond yields, effectively removes the primary competitors for investment capital. The stage was set for a non-yielding asset to move. At the exact same time, a separate geopolitical catalyst was unfolding regarding global shipping routes in the Strait of Hormuz. The prospect of a temporary arrangement between Iran and Gulf states gained traction, supported by remarks from President Donald Trump, suggesting the conflict with Iran could end soon. Energy markets immediately breathed a sigh of relief. Both Brent crude and West Texas Intermediate crashed, heading for massive weekly losses of more than 9%. Since April, gold had been tracked under a descending trendline, but this new wave of buying acted as a battering ram, piercing upward through that resistance. Below the price action, the underlying momentum indicators validate the move. The daily relative strength index pushed near 67, while the MACD pointed higher, confirming intense buying strength above the $4,300 level. The immediate battlefield for traders is now defined by two key levels. The mid-June high of $4,380 sits above as the next major ceiling, while Thursday's low, around $4,223, serves as the new floor of support. The stakes are high. If buyers conquer that $4,380 resistance zone, the technical path opens up, bringing a target of $4,600 back into focus. Gold's recovery serves as a real-time barometer of American economic anxiety. In a highly leveraged global market, the loss of a few thousand jobs provides the specific volatility required to send the world's oldest currency to entirely new heights.